Three, two, one, and go. All right. Good morning, everybody. Welcome to QuantBox Live, where we get our global macro on and uncover the best fundamental opportunities. Yes, we look at long term macro, but we look at short term sentiment, the difference between what should be happening based on reason and then what is actually happening based on the collapse of efficient market theory. Because the markets are not always rational. Now, today is dominated by Friday's Jackson Hole speech, in which Chairman Powell said they were going to cut interest rates. Good. But then over the weekend, we have geopolitical risk. Dollar weak, dollar strong. So you got to be very, very careful out there. So, anyways, we're going to take a look at a lot of different things, including the Commitment of Traders report. Yeah. But with that being said, here's the little disclaimer. I know it's not the full one, but anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. And just so you know, 1 week from now, fingers crossed, I hope to have your ability for you to log into TRADARS to attend QuantBox meetings. Even if you don't subscribe to TRADARS or anything else, the only thing that you subscribe to is QuantBox. Well, QuantBox is now inside the fundamental section of TRADARS, okay, under the fundamental dash radar. So it's a fundamental radar. And what will happen is under coaching is where you'll get your room. So when you log in, you not only will you have access to the QuantBox data, but in here, there'll be a little meeting. We'll call it fundamental trading team or something like that. And so there'll be a little meeting here for the fundamental trading team. You'll click on the private room and it'll launch just like normal. And the recordings will just be above where it says meetups. There's no recordings right now, but there'll be a carousel of all the recordings you have access to. And that's how it'll work next week. Easy peasy lemon squeezy. Okay. So let's go back to the fundamentals. So you'll have access to that part of the coaching, right? The recordings will be in the coaching section, and you'll have this fundamental radars unlocked as well. Cool. Little glitchy this morning on the data. One of the data providers seems to be failing. So we got this glitch. But anyways, we should probably be able to get through it all. Cool. So anyways, what's going on in the world? Yeah, holy smokes. Look at those yields. Massive day on Friday. So the Fed said they were going to cut. Great. And so we had a massive move in the bond market. Bond market rallied, yields fell. And that's really good because, I bet on that, which is cool. Oil at 75, trying to hold its ground. We're producing a lot of oil. Maybe some geopolitical risk. Maybe the rail strike in Canada impacting all of this stuff more than the typical demand. It's probably related to supply. But as far as longer term supply, it seems like we're producing a lot of oil, and I think the rig count is going up, in particular in Kenyatta. So, anyways, oil's going up. And we talked about that at length all last week, back when this was 72 or 73. Okay, gold going up. We're riding those moving averages. Yep. Stock market's still going up. Well, once again, based on what happened at Jackson Hole, that would be the logical thing to happen. Stock market went up. Yes, well, corporations are likely to be more profitable now or in the future than they are now because borrowing costs will be less. And in fact, I would suspect Russell did even better than that. Okay, Euro dollar trying to go up. We're at 112. And Bitcoin, oh yeah, trying to get back to 70. Finally cutting through some of the resistance. And global recovery in the stock market and treasury yields falling. So all good. So when these things go up, treasury yields should fall. Cool. So everything is right as rain. Remember 5 weeks ago, we thought we were going to go into recession and the whole world was collapsing? Yep. Remember that? Nah, that's over now. Everything's good. We're going the other way. Total reversal of, we've gone from fear back to greed. All right. Let's take a look at the risk gauges more directly. Oops. There we go. And, right? Nothing's going on. Nothing's right. I'm torn. Yeah, dude. Whoa, 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 whoa. All right. Here's what most people are thinking. There's two camps in the world right now. The Fed's going to cut. Everything's risk on. Go, go, go. Buy, buy, buy. The other half of the world thinks there's geopolitical risk and tensions in the Middle East. Risk off, risk off, risk off. The reality is neither. So you're like, well, what does that make me? 50% or long and 50%? All right, the math didn't work out. How about this? 49% are long, bearish, 49% are bullish, and the last 2% of us know better. Okay, we know there's no underlying intrinsic trend. Be very careful today. But pick one of the camps to be on. And then use very, very short term. Well, you still have to balance long term charts with short term price action, but fundamentally, just realize you're still shooting at rabbits. You would think there would be a trend, but this is a cautionary tale. Okay. Yeah. And just to look at it, like over the, what do you want to do? Weekly, monthly? I guess let's do monthly in this case. Yields have fallen 12% on the 2-year, 10.5% on the 10-year. So long term, short term, they're all down. So that's hugely bullish. Dollars weak, that is bullish. S&P 500 is up, that's bullish. But yen, yen is strong, that's bearish. Okay. Once again, I have gold being sort of an inflationary hedge, and we'll see if I have to change this. So I'm scoring it negative. We will know on Friday when PCE comes out if inflation is actually gone. Is it actually gone? Well, that's what the government is telling us. And you'll look, I'm not a conspiracy guy. I'm not well, I'm sort of anti-government, but I don't do my economics that way. We are told inflation is, I mean, literally, if we look at Jackson Hole on Friday, Jay Powell didn't even mention inflation being something that the Fed is paying attention to. It's all employment now. So I guess inflation's fixed. And we're closer to 2.5% now, right? Everything's good. Everything's right. But you have to understand that's the rate of change in inflation. So if things cost 100% more than they used to 5 years ago, and we have CPI at 0, well, then we've gone back, right? No, we still have things at 100% more than they used to be. They're just not growing more and more and more expensive every year or every month. So things are still expensive. So everything isn't fixed, in my humble opinion. It's just not getting worse. Okay. So anyways, we can read into all this stuff as much as we want. But what I was saying is if PCE is down on Friday, and we really don't care, I could switch this to a positive and have this as an increase in aggregate demand, which is risk on bullish. Okay, volatility is down a little bit over the month. Neither here nor there. And okay, how about the puts and the calls? There's more puts still out there month over month. which is bearish. So the best case scenario is this is a 2, not a 1. No, it doesn't matter. So this is the reality. Okay, this is the reality. Be conservative. Okay, be conservative. Be conservative. So what is moving? Bitcoin is way up. And there we go. I mentioned Russell. Okay, I mentioned Russell. It's most sensitive to interest rate cuts. So now that Jay Powell has told us cuts are coming, Russell's going to move the most. Now, I mention this every day. I don't know if it matters. I don't know if you trade it, but you could be. You understand? I want you to understand the connection of interest rate cuts. So, in the reverse, let's go to the reverse world, the gobbledygoo world, the upside down world. If the Fed was going to raise interest rates, you'd short the Russell first. It'd just be like that for you, instant reaction. In this case, the Fed's cutting, boom, Russell's up. Okay, nice. All right, so let's get rid of crypto. And how do you measure this? Delete. Okay. Does it look like this to you? If that's how you read that scatter plot, then it's risk on. Okay. That's it. That's how you want to look at it. That's how you use a scatter plot. So, yeah, for the short term, you might consider that. Another way of looking at it is almost everything on QuantBox is correct, meaning the long-term scores. So when you look at the scatter plot, you're looking at the bottom first. The scores here, everything positive should be up, everything negative should be down, and virtually everything is correct. Thank you, QuantBox. The long-term score and the short-term reality, this is what's happening, have congruency. So the scores and the reaction to the market is correct. Very cool. Now let's go to, actually, I want to do majors. And dollar week, dollar week, dollar week, dollar week, dollar week, dollar week. Risk on. Okay, risk on. Just the dollar. Now, normally we would correlate all this stuff, right? But we also know that it's not quite happening quite yet. Okay. So I added the stock indices. You would assume if dollar is weak, the stock market would be up. Nikkei is up 0.4. That's not a bad day. FTSE up is 0.48. DAX is up 0.76. NASDAQ is up 1.01. Dow is up 1.14. S&P 500 is 1.15. And the Russell, that's what I'm trying to teach you. The Russell's in this fundamental situation, you would expect Russell to outperform the others because of its duration. Duration isn't really about time. Duration is about the sensitivity to changes in the interest rate over time. Okay. Cool. And now this is likely to change prices of things. So how would I do this? Well, there's two markets that I'm tracking right now: housing and used cars. Housing and used cars. Right now, if you were to lease a car, I think leases and car loans are like almost 9%. Whoa. That means financing of cars is down right now. And because of that, sales are down. And because of that, prices are down. And we've talked about this a couple of times, but now it's kind of an interesting time to bring it back up because prices are down because nobody can afford the financing. Same thing with houses. Now, existing home sales were actually good last month, but over the course of, let's say, the last year, have been not good. And that's because mortgages are too expensive. People can't afford a house. They don't want to buy an existing house, right? All right. So there's all of that. So, what do you think will happen when leasing costs come down or mortgage costs come down? Well, now more people can afford the financing. So now there's more people in the buyer pool. And when there's more buyers, there's more offers. When there's more offers, the price goes up. And we're right in this delicate point where um, prices are down, but there's no buyers. Soon the cost will go down, but the price will go up because there's more buyers. You see, there's less buyers, price is down, more buyers are. So, anyways, if you were going to buy a house or if you were going to buy a car, um, there might be this interesting time where they're unaffordable on the financing side, but they're affordable on the price side. You see? And so when the Fed starts to cut interest rates in the future, the value of those cars were going to go up. I mean, that's a dumb example, but we've seen it before. But then, definitely with houses, if suddenly there's 500% more people that can afford a house because let's say 2 years from now, mortgages are pretty close to half of what they are today. You're going to get a more than double the amount of people because there's pent up demand. So what'll happen is their mortgage is cheaper, but they're going to have to pay more money for the house. I would rather buy it now when it's too expensive for most people to buy it, so you get the low price, and for the next 2 years you pay the higher mortgage. You take it as a loss, but only for 2 years. And then when the Fed is done its cutting cycle and we're at neutral rate, then you refi, but you bought it at the lower price. Don't wait for the lower rate because the price will be up and it's a wash. So, anyways, I think when you see things like, see the Russells benefiting because they might, as interest rates come down, it's going to impact them more. But I wonder if it'll impact negatively down the road in some other way. Right. So you can finance the purchase of a factory, but in 2 years the value of the factory might be 20% higher. I think housing is going to go up 20% in the next 2 years. $1 million house in 2 years from now will be 1.2 million. Oh, but cheer up, your mortgage is cheaper. You see how you want to get the balance? Buy it now, save 200,000 and then refi in the future. And how much do you actually lose over the course of 2 years? Let's say 20 grand instead of 200 grand. Huh? Wicked smart, right? But there's a relationship with price, right? And cost. Cool. Anywho, that's what I think is going on in the world right now as far as finance. How do you balance that? That's finance. Okay. Chris says, has property dropped at all in the last 18 months? No, but there's no buyers. But there's also no sellers, Chris. And in some measures, right, Chris, the United States is short 2 million houses. So, Chris, you could just come over to America and become a home builder. Just quit your old job, become a home builder, and you could build 1.5 million houses and still have tons of market to serve, right? Yeah, there's 2 million houses as far as the shortage in the US. Nobody's selling. So put it this way, Chris. Let's say I sell my house. Where am I going to live? Well, I have to buy a new house. Okay, what's my mortgage? 3%. What's my new mortgage? 6.5 if I get a new mortgage. So I'd have to get a house half the size and pay the same price. Well, hell's bells. Why would I do that? Doesn't make sense unless I have to move, right? So nobody's selling. But then if I sold it at the market rate, nobody could afford it because my house has gone up 200% since I bought it. And now someone would have to pay a high mortgage on top of that, which means their cost compared to mine is probably 300%. You're like, whoa, bro, nobody can afford it. So, but remember, this is because of government intervention. And again, I don't say this as a conspiracy theorist, anti-government, whatever. It is true. Right, supply side economics from the Chicago School. I don't know if I'm a Chicago School guy. Here's Milton Friedman, the University of Chicago Department of Economics. But there is a manipulation, and it was due to COVID. And now there's imbalances as a consequence. I mean, I don't think that's a conspiracy theory. And so the interest rates are unusually high. And you can do your research, go back through history and say, well, how many times do we have like 2.5% inflation and 5.5% interest rates? And the answer is never. Okay. And so does that have an impact? Well, how about, interest rates being at zero? How often have we had that? Well, before COVID, interest rates were zero. Post COVID, they're 5.5. Like, it's all government intervention, and there's a consequence to that. At some point in the future, I hope we get back to more free market stuff where there's naturally an equilibrium between supply and demand, and it works. Let me tell you, it works, right? Economics works. If Macy's buys too many sweaters and they have a whole boatload of sweaters. Now think about it. When they buy sweaters, they don't buy them in the winter. They buy them 6 or 9 months in advance, and then they have to be manufactured and shipped to the United States and then distributed amongst all the Macy's stores. So they do that 9 months in advance. But what if it's a very, very, very warm winter in the United States this year? They're not going to sell sweaters, are they? So now Macy's has a bunch of sweaters. Supply is too high. What is Macy's going to do? They're going to lower the price. Okay. Or they can pray for cold weather. And if we get cold weather, sales of sweaters will go up, right? So the demand will go up. But in this case, if it's an ultra warm winter and they bought literally a boatload of sweaters, they'll have to move the inventory. There's a cost to having that inventory. Plus they paid money up front. So anyway, so there's cost of that financing. And when that financing is high because of Fed funds rate, right? You see there's a connection to everything. So anyways, how does economics work? Well, Macy's would lower the price of sweaters and the inventory is likely to move. Okay. Yeah, what's the average rate of mortgages in the United States? Yeah, I believe it's about that, about 6.35 or something. I haven't looked in a couple of weeks, but that seems about right. All right, so anyways, look, we're cruising along. The way to read this chart is the general trend is this way. I think you would agree with that. Good. That's risk on. Okay. The second thing is what's happening most recently. more down than up. Yeah, we had some consolidation, but over the last few days, it looks like it's going down. Okay, that's also risk on. Then, relative to the medium term average, the 8-day average, okay, we're below the dotted line. That's also risk on. Okay, so directionally, there's some risk on. Just realize we haven't made a lower low in a while, huh? Okay, but that could happen today, yo. That could happen today. How cool is that? Make it a lower low. That is so good. And I think that will likely happen, if not today, soon, because here's the anticipation of the Fed cutting. But now we've actually learned the Fed's going to cut. Okay. Does this chart follow price action? Well, it's not price, it's yield. But the yield has a relationship with price. So if I flip this chart upside down and we had price here instead of yield, it would be going to try to make a higher high and break through resistance. So the answer is sort of, yeah. There's some price action there, but this isn't price. But there is a relationship. Okay. We could call it yield action. But people aren't trading the yield, they're trading the price. So, sort of. But yeah, sort of. Okay. Quickly look at the options market. And this is what we saw earlier. These guys are now risk off. Whoa, bro. What is this? This is the entire options market. 1 billion options. And what does it tell us? They're already risk off. One of the things we're trying to do is find congruency. If all the markets are risk on, be risk on. If all the markets are risk off, be risk off. But what if these constituencies don't agree? Well, no, this would not be a hedge. Okay. Okay. Well, let's say, but Felipe, let's go with it. Let's say it is a hedge. Why are they hedging? They think the stock market's going to fall, risk off. Okay. Okay. That's all. But what I'm trying to show you is these markets right now don't quite agree. Now, I'm a little surprised by that because the Jay Powell speech was that clear. But maybe they've already bet on all of that. That's already done. But nonetheless, what we should be doing over the next few hours and next few days is, since we have this data, which very, very few market participants have this kind of data. We're very special. Honestly, this data that QuantBox / TRADARS fundamental analytics, this is really, really, really good data. I really hope you are starting to understand that. What our insight with this tool and the risk gauges is incredible. And so we know there's some danger out there, and by danger, risk, and by risk is bad, right? You would expect this market to be risk on today, and it might become risk on today, but it's not risk on now. So the power of this is you can step away from the risk and protect yourself. QuantBox might help you not lose money today. Okay. Everyone else is just another victim. So be careful. We do not have congruency yet. Maybe we develop it later today or tomorrow or later this week or maybe next month. We don't know. That's why we have to measure everything quantitatively. And everybody else is just a victim. Okay, what else is going on this week? Okay. Is there a lag? Very, very little. Okay. Yeah. It's not reading 5-minute charts, Chris, but we're looking at the daily and weekly stuff is quite sensitive. Yeah, yeah, yeah. And look, how about this way, like Chris? Let's say risk on does develop and we get a move that goes up for the next 90 days. And today it's mixed. We know that quantitatively. It's not that we feel like the markets are indecisive. We know quantitatively they're indecisive. So, should we trade today? If it's going to be up 90 days, what if we wait and not trade so much or trade smaller lot sizes today? And over the next few days, it does become more clearly bullish risk on. And then we tiptoe in and start now. If we missed the first 18 hours because it was ambiguous, is it really such a bad thing? No, it wouldn't be. Okay. We're not trying to beat the market. I want you to understand that. We are not trying to beat the market. We are trying to trade with the market. And once you really connect with that, then we say, look, we want to be long. We think we're going to be long. I think everybody thinks, which is common knowledge. If I think that if I know that you know, and you know that I know, okay, and then it's common knowledge. I think it's common knowledge. There's risk on that's coming. Does it exist now? No. So we wait. We're waiting for the wave that we could ride. And there's no wave right now. Cool. I'll wait. The rest is guessing and gambling. Okay, cool. Consumer confidence, don't care. Aussie CPI, yeah, that's a doozy. Okay, tomorrow night. Wednesday, okay, nothing on the calendar here, but what is the volatility? This is economic data. But what will create volatility around 4 o'clock on Wednesday? Does anybody know? No, well, your Jim says oil, but that would be 10:30. 10:30 a.m. What about 4 p.m.? All right. Market close. Yeah. Well, it can. How about this? Unusually high volatility around the market close. Thank you, Denise. NVIDIA. NVIDIA is reporting their earnings. Yes. Thursday. Okay. Cool. Cool. Okay, we got our GDP. Okay, great. And it's not on Friday, isn't there? Interesting. Okay. Well, what can we derive from gross domestic product that would be useful for us to know? If we analyze GDP on Thursday, on Friday, what could we what could we discuss? If somebody gave you GDP on Thursday and you analyzed it, on Friday, what could we discuss? Jim, now you're making me jealous. Well, what about me? I do that too. What about me? Yeah. Only child, huh? Yeah. I want you to love me. Yeah. 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 What do they always say in the movies, right? The cops, I work alone. Yeah. Anybody know? I know it's such a weird question. All right. Friday has PCE. Okay, because GDP is equal to C plus I plus G plus X minus M. Well, under the C, you can derive, well, what is C? Consumption. What's PCE? Consumption. By whom? Personal. People, not business consumption. People. All right. Personal consumption. Well, GDP, the C is consumption. You could also say consumers. I used to tell people the C is for consumers, I is for businesses. See, consumers don't spend, they don't consume. IBM doesn't eat. It's not a person. It's an entity, but it's not a person. It doesn't eat. It doesn't consume. It doesn't buy a TV to watch. If it buys a TV, it's an investment. If they build a factory, it's an investment. Businesses invest. Now, consumers invest too, but very few things for a consumer is an investment. Think about all the things you own. Just walk around your house. How many of the things in your house have gone up in value in the last 10 years? You're like, wait, that lost money, that lost money, that lost money, that lost money. Everything is lost money. Now, if you don't like it, call it depreciation. Okay, it's depreciated. Okay, well, the one thing you might own are stocks, bonds, gold, right? Some currencies, and a house. Okay. And if you're Jim, a little jar of raw crude oil sitting on your desk, maybe that's gone up in value. But very few things in your life. So consumers consume, businesses invest, right? That kind of stuff. Now, Felipe says it's only a preliminary. Yes. But what I'm saying is, I don't need to see this calendar because I know PCE is here. And the Fed used to care about PCE. Now it says it doesn't. But wouldn't it be weird if PCE showed lots of inflation? Because we know it's its preferred gauge of inflation. Does it mean to the Fed, if they're thinking about 50 basis points cut in September, would it drop them to 25? Or even if they're not, it's more like the market. There's still some market participants that are betting on 0.5% interest rate cuts. Okay. But what if PCE is red hot and it shows inflation going up? Then they're going to back that down to 0.25 and the dollar gets strong. So it's just that when this comes out, I know what's next. And I want you to make that assumption or that connection that PCE is just the C in GDP. And even it's a prelim, well, maybe there's a relationship. Will durable goods data today affect GDP? Well, yeah, yes and no. First of all, that's longer term, right? Like when you buy a fridge, does that impact GDP? Yes, well, yeah, it's not an investment. It's a consumption expenditure. Um, and then, so if it's new, yes. If it's used, no. So does that get into GDP or GNP? There's a reverse way you can analyze the receipts of everything. Does it get counted? Yes. Do you buy fridges a lot? No. So it does, but it's not a big, heavy impact. The weight of it is negligible because we just don't buy that many durable goods. Now, sometimes in durable goods, you get things like airplanes, and you're like, wait, all right, the average person buys a refrigerator or a washer and dryer, but only every 10, 12 years, right? Most people don't buy airplanes, and that comes through like defense contracts and stuff like that. So we often factor that out. So there's a core version of it. But here's the other thing. Um, as far as us as traders, durable goods is highly volatile. You can have a massive month followed by a horrible month. And so ultimately, I don't really care that much. Now, you might be asking a different question. Now, you asked me its impact on GDP. Yeah, it's going to have an impact. Now, you might be saying, is there a tradable opportunity in because of it? Oh, well, that's going to go to the volatility section. And the answer is in 41 minutes, is it going to move the market? Yes. Does that make it fundamentally that important? No, this is a volatility analysis. Okay. And so that's a whole different game. Okay. So is it tradable? Yes. Is it ultimately that important to GDP analysis? No, because it's too volatile. Okay. But it's tradable. Good to know, right? By the way, are you guys seriously interested in um, news trading and scalping and short term trading? I have meetings scheduled for new tools to be developed specifically for that. So we already have the volatility section. I am still in negotiations to get you a squawk so that you have a trading desk 24 hours a day available to you, because that's going to create volatility. But talk to my developers and I'm like, hey, I want this, that, and the other thing. And they're like, oh, well, we kind of started a project like this a while back and then just dropped it. But if you want some volatility data, we have something to show you. And I'm like, really? Really? You're right. I'm all excited now. Really? And so I got a meeting scheduled, I think Friday after non-farm payrolls. Um, wait, is it that? Is that? That's not this week. It's the next week. Friday after PCE, I have a meeting, and they're like excited because they're like, "Oh, you want some volatility data for QuantBox?" They're like, "We got something to show you," and I'm like, "Really?" And they're like, "Yeah, we're so happy that you want it because we kind of have something." I'm like, "Shut the back door." But anyways, here's the bottom line: would you guys pay $97 for something that is actively providing you value 24 hours a day? If it's not worth $97, I need to just hack it and just get rid of the idea. But and here's my thought too. Here's my thought where, because I want to provide you guys an all-in-one kind of tool, right? So if it's here's what I'm trying to do. I don't know if I can do this. I'm still in negotiations with a lot of different, you know, service providers. But what I'm trying to do is say, if you want the all in one package, now including the news scalping service. So there'll be a fundamental trading team, a technical trading team, and a news trading team, you see, or a scalping trading team. What I'm trying to do is like the all in one. Well, let's say, let's back up. There's a base membership that I'm going to show you for TRADARS. Everyone has to have a base membership, and it's basically the swing trading group. It's not basically, it is the swing trading group. So everyone in TRADARS will have a swing trading membership. Over at Investor Bootcamp. So it'll give you all the coaching, all the training, all the community, the Tuesday meetings, the Thursday meetings, all that. You need to have that, right? Okay, great. That's the base. Great. Now, from that, you can say, hey, I want to add QuantBox, which we call the fundamental trading team. Done. You're done. That's $97, right? So it ends up being about the same. So nothing for you, nothing's changed. Everything's good. You're like, I have swing trading in QuantBox. Good. Really, nothing's changed except the interface. And the interface is great. So there's some improvements and I invested time and money into this, right? Good. So you're like, great, nothing really changes for you financially, but everything is better. But then you're like, yeah, but I don't want the radars, the technical radars, but you do want the scalping team. So you add that on. That's $97. So now you're at 300. Cool. Now the all-in-one, I'd like it to be 350. So you end up saving $50 a month if it's the all-in-one, because then it would unlock, it would unlock everything. So that's what I'm trying to do. If you don't want the scalping, then you would just unlock, let's say, the swing trading group, the technical radars, the fundamental radars. Okay. And you wouldn't get the new scalping, the volatility and the new scalping one. So anyways, I'm trying, guys. I'm trying. I'm not trying it from a sales point of view. I'm trying to do it from a small business point of view. I have to break even. So
I can buy there.
Right. So anyways, we'll get there, man.
Could consider something.
All right. Someone's hot mic. Oh, I see. Got it. Mute. Oh, it's already muted now. Good. All right. So anyways, you see, like, I'm trying to pull it together and make it not complicated, but everything's so complicated. But look, if I'm on the wrong track, please let me know if you don't care. But I imagine when you're on this scalping team, I guess we'll call it, it'll have not just news, but definitely news, but something you could sit on this part of TRADARS and trade all day and have human beings watching the market for you, a team. Okay. Yeah. You know what, Felipe? Yeah. Here's what I think on this. I'm rebranding Investor Bootcamp because I'm moving the swing trading group and the day trading group. So if you're a swing trader or day trader, I'm unlocking parts of TRADARS for you already. It's already happening. I spent the weekend. Okay. Spent the weekend working on this. So if you're already a subscriber, we're unlocking stuff and moving things over. Everything's great. So imagine now Investor Bootcamp has no swing trading. It has no day trading. There's no coaching at all. It's only videos. Okay, Felipe? And I'm going to rebrand it as Netflix for investors. And I thought maybe to launch that, I'll unlock the stock trading course. I think that'd be a cool thing, right? Well, I don't want to say traders because I bought Investor Bootcamp. So also, Google and YouTube being kind of the same thing, they're really strange because it's an empty black box. It's like nobody works there. But they will block you from advertising. So if you say traders, or even worse, Forex, they're like, you're probably a criminal. So we're not going to promote you no matter what you do. And I'm like, I'm not a criminal. I'm a Forex trader. Yeah, well, you might be a criminal. Now, there are all these other industries, so options trading, stock trading, those guys are out. Remember those knuckleheads that are like, I'm the largest real money options trader and I'm flying in a jet. Like they do that kind of advertising. They can advertise all they want, their get rich quick schemes. But for some reason in Forex, you're not allowed. But if you say trader, once again, they think speculative and they think very low of you. This is Google. They think very low of you and us. So that's why I bought Investor Bootcamp, to get rid of the word Forex and to get rid of the word trader. And for some reason, I probably could advertise Investor Bootcamp, but I couldn't do like Trader Bootcamp or something, right? And the thing is, there's nobody at Google that could tell you why. It just doesn't make any sense, right? Yeah. Okay. So there you go, Felipe, right? Every other day there's a Forex scammer, but very little in stock, right? So that's where I'm left. That's why I had to rebrand it. It cost me a lot of money to buy Investor Bootcamp. So anyway, so I'm going to rebrand it, and maybe that would be a way to do, right? So anyways, enough of that. Let's get on with it because we need to do COT. Now, Denise, I got your email. Thank you for that. But did you notice? I believe it's updated. Okay. I think it's updated. Yeah. Okay. So it's interesting. How, right? So you have to think about it like the developers. And by the way, what's happening, guys, is Denise said, hey, this info updated, this info didn't update. So something's broken, right? And then like an hour or two later, this updated. But then realized when I had the developers put this together, then they must have two completely independent processes in which they developed this. Now, why would you do that? I'm not a developer. I'm an economist. So I'm like, this is what I want. Can you do this? Yes. Now, the thing is, over time, I say, I need this. Great. And they build it. And then 3 months later, I'm like, hey, can you add to this? And they're like, yeah, we could do that. And then, hey, could you add to this? Yes. So you would think that this is directly related to that, but apparently not. Apparently, they're two independent processes. Now, why would you do it that way? Well, it's probably my fault because but it's weird, right? So Denise noticed like gold is at 84.69, and that was updated in the new COT data here, but then gold didn't match here. But 2 hours later, this updated. No. So I don't know. Whatever. There you go, guys. Just so you know, there could be a lag between this data and that data because they're two totally independent processes, meaning there's two different databases and they're pulling in from maybe different sources. And I don't know. I'm not the developer. I don't know. But it's accurate, and that's all we care about, right? So anyways, yeah, and I love this stuff. I have to remind you, when I first started trading Forex 20 years ago, so maybe it was just after that, so maybe 19 years ago, I used to download the COT data from the CFTC website. And it's a spreadsheet. And then I'm like, oh my God, it was so much work. It took me, I don't know, I must have spent 2-3 hours, and I would highlight things that I thought mattered to me. But it was slow and arduous. And then there was a service that came out and offered I don't know, something like this. It was more. It was. It was kind of like this. I think it was more line charts, but the service came out with a visual form of the commitment of traders report, a visual form instead of me downloading a spreadsheet. And I loved it. I loved it. I don't remember the name of the service, but I loved it. I'm like, oh my God, it saved me so much time. It cost $300 a month. I loved it. So when I see a page like this, and QuantBox for you is like less than $100 a month. I'm like, this page alone, okay, is worth that. I'd even say the risk gauges are worth it, right? Like honestly, the scatter plots really, I love that too. The risk gauges are probably worth the full subscription, but the COT data is probably worth the full subscription. Like this is that important. I could just kill everything, just give you maybe this. What would be the three things? No, I love seasonality. So all of a sudden, what do you guys pay for your seasonality? I know I used one of them. What was it? Seasonax? Was it that the one? No, the other one. What's the other one? The clock one? Remember, there's something called like something clock. I paid for an annual membership for that. I don't remember what that cost. This was a couple of years ago. And I'll never forget. Check this out, because I always think of things visually, right? So I subscribed for the annual membership because I'm like, I want to know the seasonality. Okay. And I really liked the tool that they had. And I wanted to somehow incorporate that in my training. So I paid the annual membership because I like to make the commitment, right? So I commit to a year's service at this other group. Clock? Does anyone know what I'm talking about? Something clock. So, anyways, because I paid for the whole year, and maybe I paid a little bit more, but I actually got the data. They gave me the data, that data, commanded data. So here's the visual anchor. It's raining. There's a huge downpour, and I decide to open up my garage. I'm sitting on my laptop. I remember it was a Saturday because I contacted them, but it was a Saturday. It's raining. I'm sitting in one of those folding outdoor chairs. I'm smoking a cigar because I'm working on the weekend. And I downloaded the seasonal data. And guess what I found? The data was wrong. Equity clock. Thank you. The data was wrong. Now, to be fair, I emailed the owner and he responded right away and we talked about it, but I never used it since. But I remember, like, honestly, I'm sitting there, it's raining, my garage doors are open, and I'm sitting in the garage, earning, family points by smoking a cigar in a garage, right? Working on a Saturday, downloading data, going through thousands of tables, and discovered that the data was wrong. Huh. So I don't remember what that cost, but once again, this COT page is and the seasonality is worth it. Now, let me whet your appetite. Under seasonality, I love seasonality. So what I was getting to is these two pages are also worth 100% of the cost, the monthly cost of what we now call the fundamental analytics section of TRADARS. I developed something for you. It's already done. I have an additional seasonality tool I'm going to show you next week when I officially launch TRADARS, right? I'm going to unlock something for you under seasonality. It's already done. It's already built and it's awesome. It takes us to another level. It's like an, oh my God, holy schnickerschnocker moment. This is where you're going to call a friend just to talk about it because you're so excited. You're like, oh my God, I just got this new seasonality tool. I'm just freaking out. I need to call you. Jitterbug. So it's done. It's done. It's done. I could unlock it right now, but I'm not. So, anyways, thank you for being part of this group because I'm just taking everything that you're investing into this tool and I'm reinvesting it into the tool. Cool. All right. So let's get on with it. Nobody likes CAD. Everybody likes gold. Everybody likes silver. You know, when I see stuff like that, it's either risk on or inflation. I might be wrong. So this is just my opinion. I'm not so sure we've tamed inflation. But nevertheless, because when I see like, okay, what's up? Platinum, oil, silver, gold, but the stock markets are down. I'm like, what? You know what that says to me if I was just reading this? Stagflation. Uh-oh. Now remember, this isn't the price of the stock market. You're like, but the price is going up. Yeah, but not the money. There's less people in NASDAQ and S&P 500 and Russell than there used to be. It's going up, but not the number of bulls. Oh, what is going up? Real assets. So I told you 2 years ago that real assets like gold, silver, but most importantly, real estate is where you put your money, and food. So like, I don't have it here, but things like wheat and corn and beef would go up. See, when your currency is losing value, what are you going to spend it on? A gold watch? Or how about stuff you absolutely need? Like food and energy. Okay. Real assets, right? Yeah. So an apartment building, a bar of silver, a barrel of oil, a bushel of wheat, okay? A steak. That's what you end up spending your money on. Yeah. So it's interesting. If you were going to just read these as tea leaves, I would say the market is expecting not so good future, but maybe this is going to shift left. Maybe NASDAQ's going to shift left. Maybe S&P 500 will shift left. Okay. Now, how do we know that? Well, that's the flow. This is the stock. This is a moment in time. This is a balance sheet. And this down here is a cash flow statement. Uh-oh, Chris is going to get excited. Yeah, balance sheets, cash flow statements. Yeah. Yeah. Bingo. So, okay. But by the way, Chris, have you ever looked at the COT report from that point of view? Balance sheet versus cash flow statements? It's the right way to do it. I don't think it's taught that way, though. Yeah. Oh, by the way, I told you, and it's definitely happening. I don't know if I'm going to be accepted, but I'm in talks with the St. Louis Fed in November to walk into a room full of college professors, university professors, professors of economics. And we're in discussions of me walking to the front of the room, standing up on stage, and telling these professors how to teach. Oh my God. Oh my God. Why do I do this to myself? Oh, I'm looking forward to it because it's so scary. It's so frightening. Wait, what? A room full of university professors, probably people that have been teaching economics as long as I've been alive, because, once you're tenured, right? Oh my God. And I'm going to walk in. I'm not even a university professor, right? And I'm going to say, hey, listen up. You're doing it all wrong. Let me tell you how to teach. Oh my God. Oh my God. But I found, yeah, but I found a way. I just a bucket list thing. I just want to be able to say, I've walked into a central bank and I was the expert. So, anyways, I'm putting myself into this position. We'll see. So we have conversations later this week, and if they say no, okay, that's fine. If they say no, that's fine. But it just might actually happen, and I think I did a good enough job to make it potential. Right? This isn't scrolling properly. What's going on here? Okay. This part's not scrolling. The format's changed a little bit. All right, I'll have to look into that. But anyways, it just might have happened, Yeah, but Brian, right? It's just like, whoa, man. Whoa. The only other example I can think of is before I got all my Harvard degrees and stuff like that. I had no Harvard degree, but I taught at Georgia Tech University's executive MBA program. I gave a lecture there. They asked me to be a guest lecturer, and but everybody in the room had more education than me. But then I was up there teaching them, which I thought was interesting. But this is crazy for me to go in front of university professors and teach them how to teach. It's absurd. But let's do it. Yeah. No, no, you have to apply to get into the room. Yes. So yeah, maybe. And who knows? Maybe because I'm not a university professor, I have a different insight. Maybe I can provide a fresh perspective. Okay. And what I'm actually presenting is a way for the professors to make a personal human connection between economics and the student's perspective, because students don't know anything about esoteric economic models and supply and demand equations. They're like, dude, it's just more homework, right? But what kids do understand, or think they understand, is humanity. They walk around the world and not everything is right. Not everything is fair. Not everything is working like the models, they see humanity before they see economics. And so what I want to teach is early in the class to make a connection between humanity and economics so they understand the rest of the class. But I also said, look, very few students take more than one economics class, right? And then how many girls decide they want to get into economics? It's very, very few. And I'm like, but this leads to social impact and public policy. I want to inspire more girls to be in economics, to do the research and public policy if that's where they want to go. There's a path in economics. It's not just a bunch of old men, and I'm like, we need to connect humanity. There's a real world impact. If your economic policies suck, people die at a younger age. They're less happy. Their diets change. There's a real impact. You won't live as long if your society has a poor economic policy. So anyway, so that's what I was talking about. I'm like, I want to inspire young people to get into economics and do it better. Because it leads to public policy, doesn't it? All right. So anyways, Nikkei way up, money getting back into Nikkei. Dow catching a bid, which is interesting. And it is bulls. It's not bears leaving. Okay. Euro, check that out. A big shift. Way less bears and more bulls. This is really, really, really important too. And Kiwi was terrible. Now it's back, but not, it's not, I don't know. There's basically no change on the bearish side. A few more bulls, but it's still 2/3 short. So even though if there's a little bid now, I don't know. So anyways, Nikkei, Dow, the big winners, really interesting. Dow now 60-40. Now it's a defensive play though, because you might think, well, the stock market is rallying. Well, is NASDAQ defensive? No, it's the opposite of defensive. Is S&P 500 defensive? No, it's balanced. So why is this defensive? They're monopolies. Yeah, they're global monopolies. All right. So it's not a risky play. And now let's flip this here. And yeah, look, dude, S&P, not good. Swiss franc, very bearish. Okay, good. I don't mind it. I want a Swiss franc. I told you 2 weeks ago you should be focused on Swiss franc and not the yen. Actually, 3 weeks ago. Okay. Yeah. Killer, right? Killer. Treasuries, yeah. Price coming down. No, yield coming down. This has got to be yield. Price should be going up. Yeah. Dollar. Okay, still long. That's got to be changing. And you can see there is a bit of a change here. But I think this week, now that we have heard from the Fed, there's going to be a big change. Okay, just as a quick check. Okay, to show you how unusual these moves are now. Okay, they're happening before the election. I thought in January we would have cut interest rates earlier in the year. March was on the table for a while. July, I think July should have been the first cut, right? So that was part of my analysis, that we would have already had this move. So I thought the move that you see here would have happened earlier. And then, because we already got into the process of normalizing interest rates, the bigger rally would happen right after the election. But now it's happening before the election. So everything is skewed. I thought it'd be skewed late. Maybe it's skewed earlier, or maybe there's going to be some rebalancing here. But I just want you to see how unusual the market move is. And I want you to understand that this is related to the central bank. So like when you look at Aussie dollar, it almost always falls this time of year. Yeah, not this year. Euro dollar almost always falls this time of year. Not this year. So on and so forth. Everything is usually down. Nope, it's up. This is usually a risk-off period. And it'll likely be a risk-off period next year. But I want you to see the importance of monetary policy. And that is what these giant gray spikes, when everything should be down, it's up, and when everything is up, should be up, is down. That is definitely related to the Fed cutting interest rates. Okay. Cool. I see you guys giving me feedback for the Fed speech if I have to do it. Step one, be passionate. Yep. Step two, make the students interested. Yeah. Now, the way I'm doing that is to make a human connection with the study of economics. A human connection. Like, start with that. Okay. Well, Chris says, is it naive to think of a retrace in US Aussie USD? Well, I don't want you to think counter trend, but it is important to see that usually this time of year, Aussie dollar falls until like it doesn't tell you here, but I know the third week of September. So is it? But I wouldn't think that way. Is it naive? No. But what I'm trying to teach you, which is a whole different question, is I want you to trade with the trend. For some reason, new traders love to counter trend trade, and it's just not a good way to trade. So I'd rather you look at this and say, definitely up, definitely unusual, definitely unseasonal, must be related to something fundamental, must be related to the Fed interest rate cuts being priced in and all that kind of stuff. Yep. And know that it's unusual. But trade against it? No, because I want you to know that it's fundamental, not technical. Well, no, Chris, I can tell you that based on reading economic reports out of Australia, that that central bank is going to be at paused. And then knowing what the Fed has told us that they are going to cut. So when you combine paused with cut, that means up. Okay, cool. Bitcoin, we're projected maybe testing 70 in the next week or two, huh? Yeah, yep. It's only a 2 here, but it's definitely, you got a trend. So you could cautiously be buying dips here, knowing that it's trending up, but really, like when you see institutions, they're not loading the boat right now on Bitcoin. Retail is for sure. But for this to really have legs to get through 70 and beyond, we want to see a week over week positive change, get this to 60-40 or 75-25, right? But institutions are not buying yet. It's going up, but really no new buyers, huh? So anyways, that's enough. We're done. I went way too long today. Too much babble. I apologize for that. Peace on earth. May the pips be with you. May your profits be above average. I'll see you later today. Cheers.